Before we study accounting or finance, it's very important that we know the company, okay, or a firm. Um, this is the network of the companies of the finance or the accounting main activities. If you look at the point A, it's very important. This is not just about accounting and finance, it's all about your organization, the whole company. The point A says, the point A is the green line moving from left to right, right to left, sorry. It says a firm issues securities to raise cash. A company needs finance. I don't know if you remember or not, but I think once upon a time, I made a picture that a company is consisting of three things. A company is consisting of three pillars. The first pillar of the company is called financing. And now when the company have this money, finance, what will it do? Will it keep the money in the pillows? Stash it? No. The company will use it. Where? The company will invest in the projects. They will start activities. They will make, if it's an IT company, they will build up their own platforms. They will invest in R&D. They will be developing some new models. If it's the oil company, they will be having the oil rigs like BP. They will buy the haulage, the transportation facilities, how to move oil, drilling, innovating, buying new piece of land or leasing a new area of sea where they can explore the oil. That is the investing activity. So the first thing is that money comes. So this part is money come from, and this part is money goes to. And imagine this cost of money. After all, when the company gets money from financing, it's not free of cost. They have to give what? Cost. Cost of capital, right? And the cost of capital comes to be 5%. And then this money is invested. What should be the rate of investment for a successful company? When you see this 5%, the cost of money getting, and then with this money, you start building, you start buying a building, you have machinery, you have R&D, you employ the human resources, the best talent in the world. You innovate, you have a product mix, process mix. Okay? Does this 5% put a limit on you? Does it show you some mirror? Then what should be your cost of, what should be your return on capital? Any ideas? If the cost at which you get money is 5%, what should be the return on capital invested? Yes, Yarko? It should be definitely more than 5%. Otherwise, are you a charity? Are you an NGO? Well, these days, charities and NGOs earn a lot of money. So even they are not even really non-profit. So there's a limit that what you earn should be definitely more than 5%. So you earn 5%, 6%, 7%, you give 5% cost, it leaves you 2%. The question is that, how would you do it? What is the main factor? It depends on how you use this money, how well you invest This money you borrow, you get in the useful, fruitful, productive investment projects. And it depends on how well you operate. A company who operates badly will not be able to generate return more than 5%. A company who operates well, really well, knows that this 5% is like a threshold limit, is like a hurdle. Have you seen the hurdle race? This 5% is a hurdle. It must jump over 5%. And what makes it jump over this 5% is how well you operate on daily basis. Somebody said daily, you said daily basis? So this is what you are doing on daily basis. Financing doesn't happen every day. You don't get money every day for a company, right? You never invest millions of dollars every day, do you? Not possible. This decision and this decision is the strategic decisions of the company. This comes under strategic management also. The investing and financing. But this thing, you use your machine on everyday basis, don't you? The employee come to work on everyday basis. And how well you use their services, how well you operate your machinery, that is here. So a company is a triad, is a tripolar, and three poles are financing, the money comes from, investing, money goes to, and how you use the resources on everyday basis. This is the core definition of a firm. Three pillars: operations, financing, investing. Now, firm issues. If you look at the first point, I'm still on point one. This is point A here, just here. The firm issues securities. What do you mean by word security? Is it security mean you have to have somebody, a bodyguard going with you, giving you security? Is it that security means? You feel secure? Yeah, is it what I mean? The firm, to get money, to get financing, the firm issues securities. What is that security? What do you think that security will be? Imagine I'm the company and I want to start my projects. I want to get money from you. And I approach you people. And I know that you are my potential investors. And I asked you, hey, could you give me, each of you, could you give me 10 euros? Because if you are 50, so with 10 times 50, so 500 euros, I want to start a company with 500 euros. Will you give it to me? No. Why not? Yeah. Okay. Yeah. So either you must know me already. So if I'm an established company and I have a legacy, I have a history, I have a proven track record, or if I'm a new firm, altogether new company, I have to convince you with my business proposition. Is this product I'm making, is it worth? Is the process which I'm going through is worth? Does the future prospects of this business is bright or gloomy? Now what happens is that you like my idea. Imagine I'm a new company. I'm not an established company. I'm a new company. You like my idea. Will you still give me money? You will ask me what you will do. Some of you will say, Shab, you know what? We like your idea. We like your the whole proposition is fantastic, but we are scared. we have a lot of risk. The risk is that who knows, your project is a flop. And if your project means investing, yeah? If your project is unsuccessful, we will not get our money back. And then I ask you, hey folks, first of all, I appreciate that you like my idea. But the problem is with you at this moment is that some of you are a bit apprehensive. They are scared of investing, right? I asked you, how many of you are very scared? And then let's say this side of the investors, they say that, you know what, we like your idea, we want to give you money, but you know what, we are very scared of losing money. And then I asked you that who are people who are really going to take a risk? And then some of you raise hand. Yes, we are risk lovers. Then I asked you question, what made you not liking risk? You want to play safe. And what made you to be the risk lovers? And you give me the answer. One of you give me the answer on this side. Shab, we are scared. You know why? Because the risk is that we can lose everything. We can lose all the money. And then I say, hey, don't worry. I have a solution for you. You give me 10 euros each. I guarantee you that I would give you 4% rate of interest on it. So you get your money after 1 year, you get your 10 euros back, which you give to me in the first place, plus I gave you 4%. And it's a guarantee that I would give your money back to you. Is it what you're scared of? Oh yes, this is what we are scared of. Okay, I give you guarantee that the market rate of interest is 2%. I give you 4%. You like my idea? You are scared. Now I convinced you that I will not only give you your 10 euros back, but at the same time, I give you a very decent rate of interest, which you can't get in the market. Okay? Now these people, why are you risk lovers? You like my idea, they like my idea. What makes you risk lovers? And you say, Shab, you know what? We are very optimistic that your project would be a success. And we want to become the shareholder of your company. And we have a very high hope that the company would rise. We don't want 4%. We want 100%. So we want to double, triple, 4 times our money. And that's only possible if you take a big risk. So it means what? It means that you all are my investors. Are you? But I draw a line that those who are comparatively risk averse, those who comparatively dislike risk, they want to play safe. I have a financial product for you. I have a financial security for you. And the security is that I give you a piece of paper, which I say, I owe you. I owe you. You can also call it, I owe you. Which says that you give me 10 euros, each of you, and I give you 4% rate of interest. After 1 year, come back, take your money, and also take 4%. Happy journey. If you want to stick with me for more time, it's your choice. These people, I also give them a piece of paper, but I don't write anything on it that how much will be their return. Their 10 euro share which they invest can be 20 euro, 30 euros, 40 euros after a year, or it can be worth less, but it's their risk. I issue you a security, I issue them a security. You give me 10 euros, they also give me 10 euros, but there is a quantitatively 10 euros are equal to 10 euros, but qualitatively your 10 euros are safer, their 10 euros are risky. And risk is not only downside risk, risk is also upside risk also. Why are they not rational investors? No, they are rational. But according to their rationale, the project has very high expectations to succeed. So why should they only earn 4%? Come on, 4% are peanuts for them. You guys also like the project, but something is stopping you. And what is stopping you? The risk of failure. Remember, we all are investors. You are my debt holders. I borrow money from you, right? But I don't borrow from them. They are my shareholders. We succeed together, we fall together. If company is successful, you become rich, I become rich. If companies flop, I lose, you lose. But they will not lose, they will get 4% rate of interest. What does it show? It shows that investors are not same. Investors are not homogeneous. They are heterogeneous. And the one factor which make them heterogeneous is their risk profile. Risk profile. They people are comparatively risk haters, and you people are comparatively risk lovers. Risk averse, risk lovers. It means that people who are investing in debt, they are relatively risk haters, risk averse, and those who are investing in equity or shares, they are comparatively risk lovers. Look at the word, I'm using the word comparatively. Nothing is absolute in finance. Everything is comparative. Everything is relative. Okay? So comparatively, relatively, they people are risk averse, you people are risk lovers. And that's why you invest in the company. So it means that one word we find the definition of investors. The definition of investor is the debt holders and the equity holders or the shareholder is same thing, doesn't matter. Okay? So that investors include debt holders and equity holders. But you know what? Life is not easy. Some of you, I can see that some whispering is going on between you. They people are fine, they're very categorical. But some chit chat is going on, some whispering is going on between this side of people. And I say, hey, you still have any problem? You still have any doubt or something? You say, yes, 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 yes. Some of us want to give you debt for a long time, but some of us are willing to give you debt for short time. And what is the definition? What is the line of this line of distinction between long and short in finance? Any ideas? Huh? What is the duration? What is the long term? How many days, weeks, months are called long, and how many are called? Huh? How many years? Huh? Years. How many years, for example?
More than that.
Seher? In finance, the line of distinction between long and short is 364 days. Anything up to, including 364th day is short period. And if it becomes 365th or more, it becomes long period. I know that definition is more valid for economics. We have a short period, very short period, then medium period and long period, right? And secular period. But in finance, things are very hand-on, very, very black and white. And we have the short period and the long period. Anything. So it means that some of you say, Shab, we want to lend money to you. We want to invest in your debt, but not more than 364 days. I say, all right, I give you short-term contract. But some of you say that we want to invest in your company for 2 years, 3 years, 4 years. Welcome. So it means that we have one vertical line between you guys, the debt holders and the shareholders, right? But I also have one sub line between you. That some of you are short-term debt holders, and some of you are long-term debt holders. So when I make this cycle, when I make this circle, you all are my investors. Very clear. But half of you are shareholders, and half of you are debt holders. But then I also have a one line here. You are debt holder, but short term. Short-term debt holders. And what is the definition of short-term debt holders? The number of days should be less than or equal to 364. And half of you, not full, but only among debt holders are, let's say, long-term debt holders. And what is the definition of long-term debt holders? The number of days more than or equal to 365. So we have a mathematical expression for the short-term and the long-term debt holders also. That is point A. Money comes to me. Okay? Any doubt about money, about financing? So sometime somebody can ask you, hey, what's the definition? What's the difference between finance and investment? Finance is the flow is money coming in, and investment is money going out. Out where? You are investing in the projects so that you can generate so that the return on the earnings are more than the cost of financing, and the difference is that you are making success. Okay, the successful companies, there are many factors of success these days, but if you look purely from financial point of view, then your investment on capital should be more than the cost of capital. And if your return is more than the cost, you are a successful company, financially successful company. And very important factor which makes you successful or unsuccessful is this thing, operations. Now, listen it very carefully. To me, as a finance student, for me, definition of a company or a firm is 3 pillars: financing, investing, and operations. But try to understand the difference. You don't get money every day, and you don't invest money every day, but you operate every day. You get my point? So the time dimension is very, very important. Operations are every day, sometimes 24/7. Look at the multinational companies. Look at Coke, for example. They have the business operations in over 150 countries. And even within one country, they have so many capacities, so many products. Look at their operations. But even Coke or Pepsi or Microsoft, they don't get money in and sending money out on daily basis. because these are very strategic decisions which you don't take every day basis. All right, so it's very important for you to learn the background. Why are we talking about money, finance, investment? So yeah. Then comes point B. The point B is firm invest in assets. It is this side, investing. I explained it here. C, firm's operations. When you run on everyday basis, when you press the button, the machine is on, input, output, selling, revenue. The firm's operations generate cash flow. Now the money comes. Point D, cash is paid to the government as taxes. The other stakeholders may receive cash. When you get the revenue, do you take all the revenues home? No. First, what you do, you pay taxes. You pay tax to the state. Even before you pay tax, what you do? You pay salaries. You pay wages. If your building is on rent, if you rent the building, you pay the rent. That's why the word is stakeholders. Stakeholders. In this example which I created, that I'm the company, you are my debt holders, you are my shareholder, you are my investors. Investors are companies' stakeholders for sure. But there are more stakeholders of the company other than the investors also. And one very important stakeholder of the company is employee and the government, the state. Because state, you pay taxes, and then state takes that revenue and invest on the infrastructure. They give you subsidies and so on and so forth. Your employees work for you, and because they work for you, then that's why you are able to generate cash in point C. If you have bad employees, your cash flow will go down in point C. If you have good employees, educated people, experienced people, the cash flow will go up. Make sense? Do you have some more stakeholders as well? Investors are stakeholders. They are the backbone of the company. Point D says the government is a stakeholder. Point D also says, it doesn't say, but I made a point that employees are the stakeholders of the company as well. Do you have some more stakeholders of the company? You see what? I take a pause. Resume recording. Everything is good. Nobody was angry. Who was angry? Not me. Okay. Yes, Mari. Suppliers are very important. Customers are very, unless there are customers, where would the revenue come from? When you look at the word revenue, money comes in, customers, unless they buy. But before they buy, there should be something. The marker should be ready before the customer buy it. And then comes the suppliers, those who provide you the inputs, plastic, chemicals, and then you process it, and then you make a marker, and then you sell it, money comes in, then you pay the wages, taxes, and then you share the money with the investors. Okay? Yes, I stay. Now I come back to the same example. You are my debt holders. You are my shareholders. Were you? You were. And don't forget, investors are also stakeholders of the company. As I give wages to the employees, as I give rent to the landlord, as I give tax to the state, to the government, what will I give you, people? The debt holders. What will you get? You will get the interest. Yeah? And what will you get? Huh? You will get the share of profits, dividend, you get. But let's keep it simple so far. You will get the fixed interest, the flat interest. Don't complain if my company is successful. Don't feel jealous of them. You are not risk lovers. Remember, I asked you that, would you give me money? You said yes, but then you were doing a lot of, oh, no, we are scared of risk taking. I said, oh, all right, give me money. I give you 4%. Now company is successful. Don't feel envious of them. You will only get 4%. That's what we promised. But then what happened? If the company is successful, they would get a big share of profits. But on the contrary, if a company is a flop show, then they may lose. Forget about any dividend or share of profits. They may even lose their investment. But you people would still get 4% rate of interest because that's I promise. And if I'm unable to pay you 4%, you can take me to the court of law, and there will be a decree passed by the state which declare the company to be insolvent. I'm in a big risk by not paying you. But such risk is comparatively lesser. There is less pressure on my head with respect to these people because I have transferred a lot of my risk to them. But in turn, I also ensure that they get more money than what you get. On the contrary, you people were not willing to take so much of risk. It means that most of the risk was towards me. Okay? Because you have low risk, you get low return also. No pains, no gains. They take more risk, they can get more money. Can get more. There's no guarantee they would get, but they may potentially get more reward. But you people were risk averse. You were not willing to. You were very cautious. All right, take 4%. Be happy. Okay. So that's what we do. I think. Where is this? All right. So that would be that the cash is given to stakeholders, then some money is left, and that money is getting reinvested in the company, right? I would be a very silly finance officer of the company if whatever profit I get, I distribute with you people. It means I'm a very short-termist. I'm very myopic. My view is very short. If I'm a long-term, if I have a long-term horizon, then whatever profits I'm left with, I will not give you all. I will give you some part, but I will also give some of them so that I can put, when the company is growing, the needs are growing, right? Then I would be able to reinvest. So that is the part E, reinvested cash flow are flowed back into the firm. So we use a word, another word, I think it's in the British English, we say flow back, not PLOW. I think it's in America they write OW, but in Queen's English, it's flowing back. Flowing back means you put profits back to business. Let's say my profit was 100 euros. I don't give all 100 euros to you. I give you 40 and 60. I reinvest in buying machinery. Some of my machines can go rust. They can become obsolete. I buy the new machine. I buy a new piece of land. I recruit better trained labor force. So that investment I would do. That's called plowing back of profits or reinvestment in simple words. Yeah, and then of course the cash is paid to the investors that I covered already. Part of the cash flows go to the interest. You guys get interest. You folks get dividends. Yeah, make sense? And then some of the basic phrases I want to discuss with you. Transaction. What do you mean by or transaction? If you read the definition, it says that an event or business activity an event slash business activity involving the exchange of money or money's worth between parties. It means it's an activity. When I buy this marker from Prisma, there is an activity. The activity is that I interact with somebody. I communicate with somebody at the till point that I want this marker. So I take this marker to the till point, they scan it, I give them money, and I get money's worth. Look at the word, money's worth. If I pay 2 euros for this marker, it means that the money's worth of this marker is 2 euros. I pay money, I get money's worth. Yes, and it's between parties. Which party? The buyer and the seller. 2 parties. I'm the buyer. Prisma is the seller. Okay? Look, it's a very simple thing. I buy a marker. I can write 2 sentences about it. It sounds scary. An event as if there is some party going on. Or a business activity as some millions of dollars moving here and there. It's just 2 marker. Involve exchange of money or money's worth between parties. Don't underestimate. If you look at Prisma, it's a big company. Okay, but 2 euros, these very small micro activities are very vital for a big company. In fact, the companies become bigger only if they are giving a lot of attention to these small, micro, mini activities. Transaction could be a cash transaction or a credit transaction. Cash, I pay cash then and there, or I pay my debit card with a debit card. But if I pay them later on, like credit transaction, like a credit card, the payment is not done immediately. In a cash transaction, the parties settle transaction immediately by making the payment in cash, check, or e-payment straight away. These days, I think we hardly use checks. I don't know if somebody still writes checks on the bank. We even have the e-checks now. So you can even, and by the way, why should you have it? Because now you have the e-banking and the card, and now we even have the cardless payments. You can do without cards. So this fintech, that's why I use the word fintech. Financial technology is really taking. Yesterday, I got a thesis of my student, and she is from Russia, and she completed her thesis that what is the future of fintech in the Finnish banks. And it's a fantastic piece of work. I mean, it's very futuristic. So the point here is that you can be old-fashioned making a payment, or you can use the e-payment. This is called a transaction. Transaction is when buyer and seller are interacting. That is called transaction. The goods and services is another definition, another, the goods and services are very important. Another definition. You know what? It's very important in finance. You must have a very strong vocabulary of this phraseology. It's very important. Business terms. This is the only time when you can learn these things. Goods and services. Goods are tangible. When I say tangible, it means they are physical. They have a shape. You can touch. That's why we call them tangible. If you buy, we call them the goods are bought or goods are purchased. In accounting and finance, we don't use the word buy. We say purchase. Okay, and we never say purchase goods. We say just purchase. And if you sell goods, it's sales or selling. The goods are sold, or we don't use the phrase goods very often. It's understood that when you say purchase, you purchase goods, and you sell goods. On the contrary, the services are intangible. I think with this point we discussed in economics also, the material goods and the immaterial goods. Okay, the services. If you're a consultant, if you're a law company, you're a finance consultant, you are a marketing consultant, you're a bank, you are more into service industry, or if you're in the hotel, tourism, it's like a service industry. Okay, that's very clear. I think shouldn't be any problem. Profits, the excess of revenue, income, over the expenses is called profits. Revenue is the amount earned from a firm's main business related to the operating activities. It's a revenue, money coming in, but coming from the main business of the company, main business. It could be that the BP is selling oil, KPMG is providing its auditing services, Netflix is giving you those entertainment services, and Finnair is giving you the flight services. Revenue. You operate. Remember operate, that middle pillar I drew? You operate, and because of the operations, there is a money, cash coming in. I mean, the Finnair people, you buy the ticket, you give them revenue, you travel, and Finnair operate on daily basis, right? This is the operation of the company. But here, I emboldened the word principal, main activity. All the revenue which is coming from the company's main activity is called revenue. If, for example, Finnair has some spare furniture, some old furniture, and they sell in the junk yard, and the junk dealer give them some cash. It's not revenue, because Finnair is not a furniture company. But if IKEA is doing it, it's their main revenue, because that's what they are meant to do. Finnair's job is not to sell furniture. Do you get my point? The revenue comes from your business activities and also sometimes non-principal or the non-business activities. But in the revenue, we never include the money come from any other activity. Revenue means purely business activities. For these things, we use the word gain. Gain is something like a windfall gain, you know, something, nothing to do with your main activities, but something else, right? For example, you are a transport company, you provide, you make passengers fly from Tampere, Helsinki, everywhere. So you're a transportation company, but you also have some spare computers which you don't want to use. You say, we have the new generation computers. What should we do with the old computers? You sell in the second-hand market, maybe on Tori.free. Okay, you can't call it revenue. Okay, it could be your gain, but not revenue. And loss is opposite. Loss is just opposite. If you are earning money, because when you get the profit, it's like your revenue minus cost. Okay, that's the profit. But the loss is if your revenue is less and your expenses or the cost is more. That is called your losses. Okay, loss is a symbol of the company's financial failure. Okay, and if the company is having the profits, it will add to the company's resources for the future. But if a company is having loss, it will take away the resources of the company for the future. I'll give you an example. A company's total assets last year, 2019, were 200. And then last year, 2019, the company's profits were 20. And these are the profits after giving everybody, I mean, dividends are given. These are companies' surplus profits. When you go to the next year, your assets in the beginning of 2020 would be 220. Now you don't have 200 euros at your resources, at your disposal. You have 220 because these profits are adding to your sources, your capital, the company's financial base. On the contrary, if you had a loss of 20 last year, then this loss would be adjusted from your financial resources, which is called assets. And you are left with this. So as the company having losses over time, the company's financial resources called assets are shrinking to the stage that the company's resources are so less that it has to be declared bankrupt unless you do some big radical change in the company. Does it make sense? Okay. So these are things which I want to talk to you today. That profits and losses are adjusted in the company's resource. So very quickly, I want to have a discussion with you about all the terms, the phrases that we studied today. I think today we discussed about the revenue, did we? The company have the revenue. Now this is Kone. And I'm looking at the company's consolidated statement of income. This is the statement, this is the account which will show you how well the company's operations have been. Okay? This statement of income is highlighting this thing. You borrow, the money comes from, of course, if it comes from, you pay a cost. The money goes to, which means you invest. Your cost, if you have the profits, if you are successful, you are able to pay the cost, and at the same time, you are able to make profits. So this statement of income is some kind of a proof that your company is successful or a failure, but you have to be very precise. Successful in what sense? In terms of its operations. If operations are successful, you will have profits. If operations are unsuccessful, you will have losses. So first of all, let's check if company is having success or a failure. Okay. Look at this. Move this picture this way. If you look at the company, 2018, I think these are in million euros here. So because it's in the million euros, is it? Yeah, million euros. It means it's 9,070, so it's approximately 9 billion euros. So company called Kone have the revenue of 9 billion. You can call it sales revenue or sales or revenue. Remember that these people who make accounts of this company don't know that Shab Hundal is teaching you accounting course. So they can't write the terms according to me. So it's very important that you understand the synonyms. Okay. The phrase I try to use, I will try to explain or find out, also known as expressions. But sometimes you have to dig deeper and make your own common sense that what it means. Sales revenue or sales or revenue are same thing. And that's the company's money coming from its operations. How much? 9 billion euros. And these are the company's cost, expenses, and depreciation. I'll explain what is depreciation. But the main thing is that the company's operating income is success. Okay? The company is successful. Can I say it? Can I say company is successful? In terms of operations. Can I say the company is successful in terms of its operations? Then what happens? I see last year, this is 2018, this is 2017. Look at the company's operating profit. 1192, here 1042. Do I still stick with my statement that company is successful in terms of its operations? Yeah. When I see in the absolute sense formula says that as long as your operational profits, your revenue is more than the cost, you are operationally successful. But when I compare with the previous year, or for the same year with the two companies, let's say I have Kone and its rival, only 2018, and I compare them, and I find that both have positive operating profit, but the rival has larger profit, all else being equal, ceteris paribus. Then I can say that even though Kone is absolutely successful, but comparatively, I have some doubts. When you say doubts, when you compare, when you have, now here I have two statements. When I see the company's performance in absolute sense, I'm very happy. But when I see in the comparative sense, I'm not so happy. And that gives me a food for thought, start exploring what happens last year, what good thing not happened this year. When I have this kind of attitude, this is called the attitude of skepticism. What a word, skepticism. Can you say it 5 times without interrupting? Say it 5 times at a speed, full speed. It's a nice tongue twister, isn't it? Huh? So you took it seriously. I thought it was a joke. So here we have the absolute values and the comparative values. So one thing is for sure that the company is successful in terms of its operations. Look at the word operating income. You know what? Income sometimes is a confusing word. I would rather call it profit than income. Okay? Sometimes people confuse income as revenue, which is this, sales revenue. Okay? So if I were the accountant of this company, or if I have to advise this company, I would say that, hey, don't call it operating income, call it operating profit. Okay? It's not same. Profit, income is sometimes mixed. Many people would associate income with the sales revenue, but profit is the residual. Profit is the residual leftover between the revenue and the cost. And then there are shares of associated companies, for example, which is negative. It means that the company invest, let's say Kone, it's minus 2.5, yeah? And look at the word share of associated corporate companies net income. Can you make out what is this associated companies? It might mean that Kone has some business collaboration with some companies abroad. And from there, they are not having a profit, but having a loss. Imagine Kone has invested some money in Malaysia, in India, in Southeast Asia, and overall, they are having a loss. And when this loss comes to the main company, the parent company, there we have, sir, then here we have a loss. So this is a, and then comes financing income. Mm-hmm. No. There's a difference. This is a very, very good question you raised. We use different phrases for associated companies, affiliated companies, joint ventures, and wholly owned subsidiaries. If Kone has opened up a new company in Indonesia right from the scratch, then this is called wholly owned subsidiary, or many my Scottish colleagues call it subsidiary. If Kone has invested, Kone is a multinational. If Kone has 100%, it's called wholly owned. Wholly owned. Subsidiary. The second form of collaboration, foreign collaboration, is called joint venture. I'm not sure about exact percentages, but my hunch is that if you have 50-50, something around 50% Kone and 50% some Indonesian company, it's a joint venture. So let's say if you make a rule of thumb, 50%. But if you have some joint venture with a foreign company and you own only 25-30%, approximately, but certainly less than 50%. You're not the major shareholder of that operation. That's called associated company. So if it is below 50%, then you are called associated company. Okay. So we have the wholly owned subsidiaries, then joint ventures, which is nearly 50-50. If it is below 50%, then it's a subsidiary or subsidiary. And from there, you are making a loss of 2.5. And then comes finance income and finance expenses. The finance income is Kone invested in some shares and get money, get profit out of it. And finance expense is that Kone, me, paid you 4% rate of interest. Remember the example? Do you remember or not? Finance expense is that when company is paying to its debt holders, that is called finance expense. Finance income is not your main income. Remember, it's not a profit. Are you trying to understand? Kone, it's Kone, right? Kone is not a bank. The money which comes from, you invest in the assets, but sometimes you save some old profits and you start thinking, hey, I don't think it's a good idea to buy a new machine. Why can't I buy Finnair's shares? So Kone is buying Finnair's shares. It's a financial investment of the company. And from there, if Kone is earning some money, it's a finance income, but certainly not operational income, because Kone is not a finance company. Remember it. It's a other than main business activity income. That is why this income is not a part of your operating profit. Are you with me? Operating profit is the revenue coming from the core business of Kone minus expense related to the core business of Kone. And whatever is left is operating income, because that's the main operational income. That income or the profit, even though I call it profit, not income. Income is confusing. That profit is arising because of the main core principal businesses of Kone. But since the company is big, they also have some non-core business investments also. And if the money comes from there, it's called financing income. And at the same time, Kone has its investors, Kone has its debt holders, and that money which Kone pays them is called finance expense. Okay? Make sense? Remember, this is not an operational expense. Kone's operational expense would be everything which is about making those elevators, but not about raising money. That's a financial side. That is the Kone's income or profit before tax. We call it, Kone is calling profit and income as synonyms. I will not call it. I would rather call it earnings before tax or profit before tax, PBT or EBT. Okay, and from there you pay taxes. Which taxes? The corporate tax. Can you see here with a minus sign? Kone has paid 241 million euros last year. And then you have the net income. By the way, this is also called gross profit. So the different words, it's called earnings before tax or profit before tax, or in the old fashioned language, it's also called gross profit. And from there, you pay tax to the state. Which tax? Corporate tax. And then whatever is left over is called, you can call it net profit, or it's earnings before tax, then it becomes earnings after tax, EAT. Or this was profit before tax, we can call it profit after tax, PAT. So this is the final report card of the company, that overall, at the end of the day, the company was richer by 845 million euros. Okay, now this is the money which some part of it will go to the shareholders. Remember, so far I only covered you guys, not these people. From 845.2 million, some money would be going to the shareholders, but not all the money. And some money would be, what is the word? Flowing back, reinvested to the business. Make sense? So this is the report card of the company. The performance check or the report card of the company can be seen with the income statement of the firm. And here, in case of Kone, you can see that the report card is not so bad, even though when you compare with the last year, things are not as good as the last year were, but I have nothing much to get worried. It's not a drastic fall, but maybe it gives me some more inputs that, hey, I think I should explore it. Why the profits, operating profits and net profit, why they are lesser than last year. Okay, and that's what you will do now. Now I'm leaving, but you will not leave for the remaining half an hour or a bit more. You have your computers, okay? You share computers or sit in a way that everybody have access to computer. take a company from Finland or abroad. Make sure that it should not be, it must not be a financial or a utility company. Okay, Seher can help you which company you pick or which you don't pick from. Okay, and then you go to the income statement of those companies and check out their revenue, cost, finance cost, operating income, gross profit, net profit, and see if you find something interesting observations. And if you find something or you are not sure of something, ask Seher, she would help you. And I leave it to you. Good luck. I see you next week. And I'm recording it, so I would send the video to you so that you can recap whatever. Okay. I need my computer. You can.